Hello, hello. Welcome to the August, should probably update this right here, the August monthly charting session. Tonight's session is going to be a little shorter than usual simply because we don't have as many trades to go through. We're going to spend more of the time on kind of building the expectation for what we can reasonably expect over the next few weeks. Aptly named Navigating Summer Volatility. It's not the time to freak out, but it is the time to prepare. Something that we'll talk about extensively over the next 45 or so minutes is just how important it is to be ready to buy the pivot. If the pivot never comes, as you'll see throughout the presentation, we will be short. We will have opportunities to make money to the downside. But I cannot stress enough, do not bet the farm that was the top of this cycle. If it ends up being that way, we'll make money and navigate it just fine. It's imperative not to get trapped in that bearish mentality, miss the pivot, and miss out on Q3, Q4 ramp up through the election if it happens, which statistically it should. So let's go ahead and start. Once again, welcome to the August monthly charting session. Let's talk through navigating summer volatility. First things first, the disclaimer. Please don't be stupid. Don't risk more than you can lose, and don't misconstrue anything we say today as buy or sell recommendations. We've done a pretty good job. We talk about this inside of the Discord during the trading hours about how we've been able to protect our capital and the yearly P&L. Most of us are in 2-week drawdowns, which is a given considering we are a breakout and momentum style trading group. But able to protect the yearly profits is pivotal during market pullbacks such as now. So don't risk more than you can lose. The 3 tenets of TTI, for those of you that are new, we focus on price and price alone. News is noise and everyone else lies. Before I go on, I just want to say that you could go through every single year and pick out 1 to 2 different events to explain why price drops. Last year was a regional banking crisis that took us out in February and March. The year before that was, Chinese real estate and commercial real estate was going to burst. And then the year before that, the Archegos blow up, the gamma squeeze, and then subsequently ushering in a bear market. The simple fact of the matter is that price tends to move through seasonal waves. Seasonal weakness is summer is to be expected. Now, not every single summer is going to be as weak as the last, but understanding that generally during the summer period, there is going to be seasonal weakness. Having that baked into your trading plan so that when pullbacks occur, you're not caught off guard. Plug and play whichever news event will make you feel good. Obviously, this one had to do all about the Japanese yen. We're not going to focus on that. There's plenty of material that's going to be coming out tomorrow on that. But please just focus on price. Second is absolute and relative strength. Own the strongest stocks, or as you're about to see, we want to short the weakest stocks. And lastly, momentum. We want to be buying stocks moving rapidly towards price targets, or in this case, shorting stocks moving rapidly to price targets. Since we last met for one of these monthly charting sessions, Biden has chosen not to run for re-election. That has thrown a wrench into our election year seasonal pattern. Mr. Jeffrey Hirsch from Stock Traders Almanac updating the seasonal framework for what to expect during election years. If Biden were to seek re-election, and we had both parties clearly lined up from the beginning, historically speaking, we move anywhere between 11 to 20% on the year. When there is a party that is not seeking re-election, so it's an open presidential election, the overall performance on the year does suffer. So now that we have the Kamala ticket and the Donald ticket, we are not having a president seek re-election. The market does not like uncertainty more than anything. Regardless of your political affiliation, I challenge you to go look at the data between the Republicans and the Democrats and how the market has moved through all of their terms. I'm going to give you a hint. It goes up. It doesn't matter necessarily who the president is, at least from a primary trend standpoint. What they care about is knowing who's competing. So Jeffrey Hirsch here showing us that during these summer months, we tend to have pullbacks. Seasonal weakness is there regardless of what year it typically is, where we are within that election cycle. Where we go towards the end of summer is going to be key. Generally speaking, election years rally through November. I'm going to say that again. Generally, during election years, the markets rally through November. They rally up to and potentially past the presidential election. We're not going to blindly trade that, but bake that into your trading plan. Typically, going back to 1949, they rally. Let's talk about performances from a U.S. sector, industry, and factor analysis standpoint, because a lot of things have changed very rapidly with the degradation of the market. 2 weeks ago, we were sitting near all-time highs in a bunch of different indexes, equal weight and non-equal weight. Now, we have pulled back rather dramatically. Elevator down, as some would say. Your performance is now being dominated by utilities. Hard to say that it is an incredibly bullish and risk-on environment when utilities are leading. Before I continue, I will say that this is not an inherently bullish or bearish presentation. I'm going to present both sides of the equation, and we're going to navigate it with some prowess. Utilities now on the year outperforming everything, not what you would expect in the second year of a bull market. Consumer discretionary, which it did have an opportunity to start to outperform, is now once again underperforming everything, down 4.49% on the year. Not what you want to expect from stocks like Amazon and Tesla and generally the consumer-facing side of the market. Tech, now only up 2.87%. Want to point that out. Tech was leading, and now it's second worst and barely up on the year. That's how dramatic this pullback has been. As a matter of fact, if we look at it from quarter to date, look at tech down at 12% on the quarter. Now, a lot of this is going to be semiconductor stocks, which we're going to look at briefly. But still, the point needs to be made because everybody wants to know, are we buying the dip or are we selling the rips? As of right now, it's probably best to wait to do either. We're still on the camp that we're essentially going to be buying the dip, but as we always talk about, we want to be buying the right side of the dip, the bounce. And right now, if stocks are in free fall mode, we do not want to get in front of it. Tech down 12% quarter to date, utilities up 7.54%, and you can see everything in between. It's been a relatively weak quarter for most of the stock market. Industry performance year to date, look at semiconductors. I was just talking about how much of an impact semiconductors have had on tech in general. At one point, semiconductors were up over 60% on the year, and now they are now only up 20%. So a dramatic fall off in semiconductors over the last 2 weeks, but not just the last 2 weeks. The big boys at the top, yes, NVIDIA, but SMCI has been coming down for a while, right? And there are some short ideas coming up on semis that are breaking key levels that have been weak during the entire run-up. So before we go further, I have to ask you, if we have been in a bull market, which we have and are still currently, subject to change, most sectors are performing okay. We have stocks up triple digits, and yet we have other stocks within the industry groups that are hitting all-time highs, like semiconductors, that have not performed well over the last 2 years. In a market that begins to sell off, do you expect the stocks showing the greatest moves to sell off the most, or do you expect the weak stocks during the bull market to sell off the most as soon as any sort of weakness creeps back in from a sector or industry standpoint? Thankfully, we have plethora of data telling us that weak stocks tend to drop the most during weak markets. So everybody wants to go and short NVIDIA and stuff like that, I understand, but there are a slew of weak semiconductor stocks right now that are breaking key levels that we can get in that aren't going to have the same sort of volatile moves as NVIDIA, that don't have the same amount of liquidity, pushing it to the upside as NVIDIA, etc. So semis have dramatically fallen off year to date, still outperforming everything else, but that's how big of a lead they had. Quarter to date, check out semis, down nearly 20%. Just this quarter. Just an absolutely epic sell-off. Look at airlines. You want to blame CrowdStrike, you want to do whatever you want, that's totally fine, but they are also down 14%. Look at the areas of the market that are down the most. Higher beta, semiconductor, internet, software, etc. It's fun to trade these things when everything's shooting to the upside. You have to be able to protect yourself as the market corrects and the higher beta names correct more. That's how this stuff works. Volatility works in both directions, right? So as of right now, we're looking at the underperforming sectors and industry groups not as opportunities to buy yet. We are going to let them fully correct, find a floor, and then bounce. Factor analysis year to date. You can see the dramatic sell-off in the large cap growth stocks starting at about July 10th. My personal portfolio peaked on the 16th of July. We were talking about that inside of the Discord. I've been in a drawdown essentially since then. Other areas of the market taking over some of that flow from the large cap growth stuff, small caps, mid caps, etc. But realistically, if you go to, this should be quarter to date. I did not update that. I apologize. If you look at from a quarter to date standpoint, there's not a whole lot of outperformance in anything. It's been a pretty dramatic sell-off across the board. There's not a lot of places to hide. Small caps, which had just recently broken out, like 3 weeks ago, we had entered a bunch of them, and some of them are tapping price targets, but as a whole, small caps are getting slaughtered along with the rest of the market. You got to feel sorry for the guys that are just exclusively small cap traders. They waited all year to get their small cap trades in, and they had like a 10-day window. That was it. They've had 10 days of upwards performance in 7 months. It's wild. There's nowhere to hide. Let's talk through indexes here from a logical standpoint. We're going to look at the S&P 500, the Qs, and IWM on the weekly. If there's any questions, by the way, feel free to ask them, and I'll routinely go ahead and flip over. The S&P 500 is pulling back, as we all know, but check out where it pulled back. And this was something that I had just tweeted about, and I think people need to be reminded of. It's not like the 1.618 fib extension is going to tell us all of the answers. We can't reasonably assume that always it's going to get hit and then there's going to be this nasty correction. But it did happen, and we did start to plan for it the first week of July. There's some self-fulfilling prophecy when it comes to these 1.618 fib extensions because nearly everybody in the market with a couple bucks knows how to set these ranges, and nearly everybody's starting to take profits at those levels. We're all risking off of them. So it doesn't surprise me to see us pull back off of this 1.618. What I want to know is, where do we find support? Where is that right side of the bounce? For the S&P 500, it should be right around here. Realistically, if you're looking to buy the dip, you'd expect this particular range that we are in, somewhere near the 515 area, to hold as support. We're going to look at this zoomed in a little bit, but we're not there yet. So we don't want to get in the way. The Qs have undercut that same kind of level. Previous resistance, now turned support, has been undercut as of today, and therefore we want to hold off on opening areas or opening stocks within the NASDAQ. We don't want to try to catch the knife here. It doesn't make any sense. Next level of support is the 40450 pivot, those previous cycle highs. If the Qs want to correct all the way down there, which absolutely they could, we don't want to end up buying down into that level. That's another $20 that the NASDAQ can come down before we're even buying. We want to wait. Wait for the dust to settle. IWM right back within that range. Just like I was saying, small cap traders have had a hell of a year. They have just not done anything consistently. They had a 10-day period where we spiked up and we're right back into the same range we've been in for the last 6 months. None of this is screaming get short with all of your portfolio, by the way. It just means that we need to take our time and be patient before we start accumulating positions again. Mid caps, right back down below previous cycle highs and stuck within the range. More information telling us don't get involved yet. Just wait. The Dow Jones Industrial Average, chopping around. We were just at all-time highs a week and a half ago. Now we're right back where we were over the last year, just chopping sideways. More evidence. Don't get involved yet. The Dow Jones Transportation Average, we were just talking about like a week ago. Hey, a week and a half ago, before the market really started to capitulate, we said the Dow Jones Transportation Average was starting to show a little oomph. Maybe we're going to get up there and break out, and maybe it's going to be joining the Dow Jones Industrial Average. And going back to Dow theory 100 plus years ago, that means that the market is moving efficiently within a bullish uptrend. And yet here we are a week or two later, back-to-back declining weeks, and we're still stuck within the same range that we've been in since 2021. Further evidence, don't get involved yet. Now, the reason why I'm not on board with shorting everything in the market, it's very easy to get caught up with this stuff, guys. It's very easy to, especially if you have your portfolio loaded with like straight calls or something into something like this. I understand it. We've all gone through it. But the market data is not yet implying that we are going to break this primary uptrend and head into new lows. It does not coincide with the market top. Matter of fact, we were just going through a webinar last week about distribution phases. None of this is screaming distribution yet. There are individual stocks that are breaking down into potential stage 4 downtrends out of distributive stage 3s. Remember, we just talked about this, which we're going to look at in a second. But from an index standpoint, we have not. Nothing here is screaming at us yet. As a matter of fact, if you look at from a market breadth standpoint, this is subject to change as of this Friday, but the new lows list, particularly the 52-week low, is not overly expanding. Not yet. Now it could. It's only August. We still have another month and a half of the seasonal weakness, but who knows? We've already corrected just as much as we did during last summer's correction. Except last summer's correction lasted 3 months. This one has lasted about 5 to 6 weeks. The Qs starting to break down. So there are new lows here, and that makes sense, right? We're talking about semis, tech, internet, software, consumer discretionary. These are underperforming areas of the market, and so the Qs are leading to the downside. So let me ask you something. If or when the market starts to find a bottom, would you expect the higher beta names to continue to break down and let the value and lower volatility areas start to catch a bid first? Or would you expect the higher beta, higher volatility stocks catch a bid first before the lower volatility and start to turn around? Generally speaking, it's going to be the Qs that are going to give us the hint, at least in a healthy bull market where tech is leading, which is generally assumed, the Qs are going to bottom first. So it's important to check the Qs on a day-over-day, week-over-week basis and see, are they pivoting? Is there a floor? Are the net highs versus lows list, which is now ticking down for the first time in a couple of weeks, has it stopped ticking down? Is it starting to tick back up? If it is, we're going to take the weight of the evidence through the Qs and extrapolate that idea out into the market and say the market's probably finding some sort of floor and pivoting. We got to get long. So the Qs are probably going to be the first area of the market that are going to give us the signs that a bottom is formed. As of right now, the Qs are below that key level, which we're going to look at in a second, and net lows are expanding. Further evidence, don't get involved yet. We talk about the volatility through VIX all of the time. Historically speaking, during bullish uptrends, we really don't get spikes above 20 all that often. And yet here we are spiking 3 times in a single day, 3 times the value. It was the largest single move in VIX ever. That's insane. A great time to sell positions, or sell contracts, take advantage of the implied volatility. But this brings me to a new point. People that are buying contracts right now, if you're trading options, not equities, but if you're trading options, the VIX has completely skewed the options premium on these contracts against you. If you are a net buyer of puts or calls, you will be paying a premium that you didn't have to pay 3 days ago because the implied volatility on the contract is up. This is not the greatest environment to be buying calls or puts. Call or put debit spreads would make more sense. Those give you an artificial hedge against implied volatility crush. But you have to understand that by buying calls or puts in this type of environment, just straight calls or puts, which most people prefer because obviously they have that huge profit opportunity that even if you get the direction of the trade correct, your premium will be severely impacted by any IV crush that occurs, meaning it's essentially like swimming upstream. Maybe you're strong enough to swim upstream, but you're going to be swimming against the current. It's not going to be easy. The trade will not be easy. Going out and buying those January 2025 calls on a dip right now because you expect this to turn around within the next 6 months, it might. But the volatility that is now priced into that premium is slowly going to decay. And so you're going to be making way less money than you should. It's just going to be a headache. Further evidence to wait before you participate. Stocks above the 50 and 200-day moving averages. Slightly degraded since the last time we've looked at these, but realistically they are not necessarily hitting any lows that are pertinent. Particularly that 200-day moving average. We are at yearly lows on that. But we're still holding well above 50, 60%. So even though there is a dramatic correction right now, you're not seeing that huge market breadth breakdown from new highs that typically happens when a majority of the market breaks down out of some sort of stage 3 into a stage 4 decline. It's just not there yet. We've pulled back significantly, but there's not enough data in my mind through market breadth to tell us that, hey, that was the top. The put to call ratio skewed heavily, obviously, after the market corrected, which it was. I should have had a daily. We looked at this earlier today in the Discord. This is the weekly. For everybody that made $1 million on the drawdown on Monday, the data shows that most people did not hold puts going into Monday. Most people bought puts on Monday. And then Tuesday, we had a huge bounce. So whether or not they held through those, I don't know. The data showed that there was not a huge put-to-call ratio. Now there is. It's elevated. Obviously, the market, there's volatility. People are buying puts as a hedge. Whether or not those actually pay them out, I'm not entirely sure. But we generally want a higher level. We want to see this skew up a little bit more. We want to get more people actively afraid because that's how squeezes occur. Bottoms tend to occur when everybody is max short. They flip the lever back up, and then everybody starts to capitulate on those puts. We're not there yet. Further evidence. Wait to get involved. High beta stocks. We were just at all-time highs 2 weeks ago, and now we are back within the range and below previous cycle highs. Further evidence to not get involved yet. This is not a full breakdown where we want to short everything. Also not reassuring to buy the dip yet. High beta versus low volatility. We spent the entire year going sideways, right back within the range. No inherent strength in high beta stocks. Low volatility is down as well. High beta is going to be down more. It's the nature of trading higher beta. Further evidence to not get involved. Consumer discretionary against consumer staples. This does not look good. It's the lowest reading since 2023. I believe it was May. We don't want to see this ratio breaking down within a bull market. It doesn't necessarily have to go parabolic, as you've seen, and if you want to back test this, go back the last 20 years. Does not need to go parabolic during bull markets, but you want to see consumer discretionary stocks, which are higher beta in nature, outperforming consumer staples, which are lower volatility. We are starting to see them roll over, and we have now the lowest reading since 2023. This ratio is starting to break down. Evidence that you don't necessarily want to get involved yet. We've talked about the high yield corporate debt versus treasuries. This was, I think we talked about it late last week on Wednesday or Thursday. This was kind of a canary in the coal mine type of chart. This was the one chart that really did scare me out of everything I've seen this year. This was the only real thing where I go, uh-oh, that does not look good. And then on Monday, we had the big correction through the yen. Did the bond market know? I don't know. But the bond market moved prior to the yen correction. And they were telling us last week to be careful. This ratio in a bull market, we would want to be moving up and to the right. Does not need to go parabolic, but we want the big money to be assuming more risk. That would reassure us that we're still in a bull market. When this ratio starts to break down, it shows you the exact opposite. They are moving towards less risky, lower reward options. Right back within the same range we've been in since 2022. Not great. We have been stuck in this particular range for a while now. This is your stocks versus rocks ratio. In a healthy bull market, you would assume that stocks are outperforming gold. And they haven't. As a matter of fact, going back to the 2020 lows, the S&P 500 and gold have tracked each other very well. This shows back to 2021. For everybody that's arguing about which one you need to own, stocks or gold, you could have owned either. You would have performed around the same. As of right now, there's a slight edge in gold, and that's because it's just lower volatility in nature. But realistically, they have performed damn near the same. Not what you would have expected unless you pull this data up side by side. This surprised me. We have a position on gold. It's doing all right. But it should be underperforming stocks within a bull market, and it's just not there. All Country World ACWI on the weekly. We look at this to have a general idea of how emerging markets, etc., are doing around the world. They were at all-time highs 2 weeks ago. They are right back to the scene of the crime at all-time high breakout 107.5 right now. It took 2 weeks. It took 6 months to get to all-time highs. 2 weeks to bring it all the way back to yearly breakout. If this falls back within the range, further evidence to wait. Chinese stocks. We took an opportunity earlier this year. 2 out of 5 or 2 out of 6 worked. Further evidence not to buy Chinese stocks. We took the PDD, we took the JD, we took the BILI and a couple other ones. It was a mixed bag of performance. We don't want to be long Chinese stocks regardless of what the tabloids say. Every year they tell us that China is going to pump the economy, and yet every year Chinese stocks do nothing but stay within the same range they've been in since 2022. We're not buying Chinese stocks until we break above that 33.5 level. It's as simple as that. Emerging markets with China included, back within the range that we've been in for the last year and a half, 2 years. Emerging markets without China have pulled back dramatically, but still holding up and over the risk on level. So emerging market stocks continue to be a point of emphasis and should be bought when the market does find some sort of floor. It's not just U.S. domestic. Equal weighted RSP. We've been waiting for this thing to break, and now it is balancing back within the range. We don't want to be trading super long positions and be very long in this market if the RSP is not also tracking the market. We just had a breadth thrust. We just had all-time highs a week ago. And here we are right now back at the scene of the crime. This is not bullish. This is chop. It's volatility. It's summer weakness. Further evidence to wait. QQEW, we are back within the range, which makes sense. The Qs are getting hit harder than the S&P 500, higher beta stocks. It's the nature, but once again, we've been here for the last 6 or 7 months waiting for a breakout. We were just at all-time highs. Week or two later, back within the range. Hands off. Bonds are ironically one of the only things from an asset class perspective that is working for us. We do have a bond trade on. We're able to flip. Most of us were able to flip the bond trade free for the January $100 calls. So we have the next 6 months free for these bonds if they decide to continue to run. From a technical perspective, there is evidence showing that the bond market has potentially bottomed, and we do want to add into it. The $100 trigger, when we do close up and over it, we will be looking to extend the bond trade out into 2025. Do want to point out that from a stocks versus bonds perspective, stocks will likely outperform in a scenario where both are moving up and to the right, but the bond trade is going to be special because it's reasonable to expect that the bond trade is not going to gap down 20% overnight, assuming it doesn't. So for those of us sitting in the bond trade, it's one of those pillar trades within our portfolio that we can reasonably assume is going to do pretty okay. We're going to want to take advantage of TLT above $100. Recent CTA data is about a week old, but it goes to show you that they're cautiously optimistic. Hard to know whether or not they got caught on Monday because the data is week old, but they were about 80 to 82% long, which kind of makes sense. Not a whole lot to take away from here. I would not be surprised to see the NAAIM numbers come back in the next report, and these are down to 60 or potentially 50 yearly lows. Generally, CTAs are super skittish. When the CTAs start to break down, I would assume that there's a higher chance that the market is bottomed because the market wants these guys to chase. The COT report, this is the old one. I want you to read this just for a second. You don't need to understand all of it. Excuse me. Give me 1 second. Go ahead and look at this chart really quick while I take a drink of water. Commercials were hedged into Monday's drawdown. We knew they were hedged. We saw them position for summer weakness during the mid-monthly charting session 2 weeks ago. It should not be a surprise. Once again, plug and play any event you want. It should not be a surprise that the market tends to look volatile when dealers and commercials start to hedge excessively. They're not necessarily betting on new market lows, but they are betting on volatility. So should it surprise us that volatility's here? No, these are the smartest guys in the game. Here's your updated COT report. Guess what? They're still hedged. The weight of the evidence shows that this correction during the summer, or I shouldn't say correction, but the volatility is probably not over yet. Commercial traders are still hedged. From our perspective, we don't necessarily want to get back into the market with any sort of size until the S&P 500 through SPY gets back above the 530 level. This is basic support and resistance levels, and the RSI needs to be above the 50. That 50 RSI is very important. It's not going to work 100% of the time. It's not going to allow us to time every top and bottom, but what it is going to do is keep us out of trades where the momentum is not on our side. The 50 RSI, the RSI right now dipping below the 50 is the lowest reading it's been since the correction of last year in October. So until we reclaim it, this is on the weekly, and we're above 530, be very cautious about opening positions to the long side. The Qs, higher volatility than the S&P 500, have more to make up. Our line in the sand is 450, and we are very much below the 50 RSI. Weight of the evidence continues to show that we should wait to get long. Buying the dip is fine, but I would way prefer to buy the right side of the bounce where the momentum is back in our favor, because realistically we don't know where these things are going to bottom out. Once again, the S&P 500 levels, if you want to mark these on your charts, 530, that's the trigger to the upside, and the Qs are 450. Take a look at those previous cycle highs. There is a chance we come down and test those. I'm not saying it is going to happen, but there's absolutely a chance. We're seeing it in a lot of other areas of the market where we're testing those previous cycle highs. IWM right back to those previous cycle highs. Bear market highs, we're right back there finding support at that 200 area. The entry trigger in IWM is up near 210. I didn't write it on the chart. Don't want to be long new small caps unless we're up and over the 210 area. We're also dipping below the 50 RSI. Very simple rule set that will keep you out of trouble. Please, please, please wait for the 50 RSI. So let's talk about a couple things that don't make a whole lot of sense. We're going to be looking at individual trades here, and once again, I want to point out that usually our monthly charting sessions, we have 50 to 100 new trade ideas. I think it's reasonable to assume that this one's going to be a little different, right? We're chopping around. There's really not a lot of things we want to buy, and we don't really want to be shorting anything in the hole when the volatility factor is so high and these puts are so expensive due to it, right? But we're going to look at what's weak and what's going on. So there's this debate going on right now from all the smartest people in the world. You got one camp that says the consumer is weak. You got another camp that says the consumer is strong. Airbnb reported and gapped down huge on some really bad readings from the consumer. 1 year lows as of today in Airbnb. I guess the consumer is weak. You flip over to Uber, who reported just a few days ago. They're up 20% post ER, and they said the consumer's strong. Starbucks said the consumer is weak. Royal Caribbean Cruises said the consumer is strong. McDonald's said the consumer is weak. You see where I'm going with this? Take these charts and these trades based off of price alone. Do not let other people's opinions skew what you want to do. The consumer is going to do what the consumer wants to do. Here's another one that should have said lows or weakness, excuse me. There's your Starbucks chart sitting near yearly lows. You got some charts. Look at Nike. I didn't add it, but Nike is down huge, right? Could it be a reflection of consumer trends? Potentially. You know, I read through some of the McDonald's report because I was curious, and they said that the average consumer is not buying the same amount of products per order, and the Big Mac sales are down huge. And, you know, you got two camps. One, McDonald's sucks. That's one camp. I just traveled 8 weeks through Europe, and every single McDonald's that I saw was slammed. So I don't know how the hell McDonald's says the consumer is weak, but that's fine. Trade the charts. A new theme that's emerging that actually matters, not necessarily the consumer is weak or strong, is that previous market leaders are now leading to the downside. This is not good. If you're in the bear camp and you want to make a point that the market is going to get worse, you start with this. Previous cycle, if you want to call it, the market leaders such as Dell are now correcting over 50%. This is now trading below the 200-day moving average, below into oversold territory on the RSI, into technical bear market territory, and it looks like Dell has no respite in sight. There's no level of support here for more than a 25% more to the downside. That's insane to think about. We're coming up on earnings in a couple of weeks. Dell could be just straight up killed before earnings. The next one, which obviously reported today, and I'm sure most of you guys are aware of, is SMCI. These are in logs, so it's a lot easier to chart these. But here's one that's down 60% from their cycle high. These were leaders in the market. These represented the bull market, and they are now down massively. Something to consider. Do you buy the dip on these? If you've bought the dip on either Dell or SMCI in the last few weeks, you are down massively, which is why we're not going to do it yet. New themes emerging. Weak stocks are breaking down. We talked about that at the beginning, and I'm going to show you a couple charts here that are ripe for a short, but I want to preface what I'm about to say with I am not shorting the market expecting bear market lows. I do not expect the market to roll over. I reserve the right to be wrong, and if I'm wrong, we will be taking shorts as they come up. But the weight of the evidence is not firmly in the bear camp yet. Now, we can take strategic shorts, some tactical shorts, as people say, particularly on charts that have our bread and butter setup, which we're about to go through. But these are generally going to be viewed as short-term opportunities to pad the account. I included the market movers portion of Koyfin, where it shows you that over the last week or two, there are a lot more losers than gainers. And the weakest stocks in the market, meaning stocks that have not participated over the last 18 months, are the first ones that are starting to break down into new bear market lows. By bear market, I mean more than 20%. So we're going to look at some of these. First one is a mid-cap semi name. We were just talking about the volatility in semiconductors. Everybody wants to short NVIDIA, and I get it, but it's not going to be the easiest short out there. It's filled with people willing to buy the dip. You have financial institutions trying to accumulate it. Other ones are trying to sell it. You're above the 200-day moving average. There's just a bunch of stuff going on with NVIDIA. Take the easier short. This is our bread and butter setup. LSCC on the daily, semiconductor at $5.76 billion. Trigger here around $41, $42, and we have some targets on the chart. Be very careful buying straight puts. We will likely have put debit spreads as our vehicle of trading these, but this is a range low breakdown trading below its downward sloping 200-day moving average. The RSI is well within a bearish momentum regime, and we have already gone through its earning report. Opportunity here on a put debit spread for a 4-to-1 or greater. Trade will be uploaded tomorrow morning prior to market open. NVO. Who had this one on their bingo card? We found this today. Good possibility that this thing bounces up into tomorrow's open as it broke a horizontal level on high volume. Now trading below its 200-day moving average. RSI is below the 50, and there's a low volume node or gap down towards that first profit target. Check the chain. Implied volatility is not high whatsoever. We can buy these puts down for around a 10% move. An aggressive play on a healthcare stock breaking down out of a potential topping formation. Why not? Notice the last two trades that we've highlighted for shorts are below their 200-day moving average. That is not on accident. It's part of the process. Short the weaker stocks. Disney. This was brought up earlier today from Edson, trader inside of our development program, just past a year. He's looking to take Disney off of a bounce back up towards that proprietary gray box to the downside around $80. Check out that bearish momentum regime we've been in for the majority of this year. Last 4 or 5 months, Disney has done absolutely nothing. Now, this is a trade that we took long at one point. Back down below the scene of the crime that we originally wanted it, below the 200-day moving average, which is starting to curl to the downside. This appears to be a massive range that it's stuck in, but it does look like there's an opportunity to short it to the downside bottom of the range and towards decade lows. Once again, hallmark sign of a weak stock. We're not trying to time the top on these things. Check out Chevron, by the way. This honestly surprised me. There are a lot of people screaming buy the dip in energy stocks. I don't know if this looks great at all for the energy sector. The second largest name in the energy sector is about to break down into 2.5-year lows. I don't think that's great. If it does break down, I'm not saying it will, it hasn't yet, but if it does, there's a target down there that we can play. Plenty of liquidity on the chain. On the right side of its earnings report, trading below its 200-day moving average, and the 200-day moving average is now sloped down. That's not great for Chevron or for the energy traders expecting energy to pick up the slack this summer. Even last summer, it was not the worst. This looks worse than last summer. So opportunity there on Chevron. And the last one I want to highlight just for tonight's session is TRIP. This is an all-time low breakdown in TRIP. It's a mid-cap now, internet-related stock we all have used or at least heard of, TripAdvisor. Trading below the 200-day moving average, right side of its earnings report within a bearish momentum regime. Another stock that we could be trading into all-time lows. This looks like something that will probably get delisted at some point. Last year, I believe it was, when Yellow went bankrupt. Yellow, the trucking company, the logistics company. A lot of people were calling for a bear market because of Yellow going bankrupt, one of the largest trucking/logistics companies in the United States. What they failed to realize is if you pulled up the Yellow chart and zoomed out 15 years, the stock had been in a steady downtrend the entire 15 years. So yes, maybe COVID put the nail in the coffin, but they were on their way out one way or the other. TripAdvisor is the exact same way. I encourage you to pull TRIP up on your charting software, put it on the weekly, zoom out. This is one of those stocks that were on their way out this cycle, it looks like, unless somebody does something drastic. They're probably going to go out of business. Opportunity for us to short it in the meantime. So we just went over some shorts, and we're going to have more as they come up, but believe me when I tell you, we are very selective with the shorts that we take. You don't need me to point out how incredibly difficult it is to short during primary uptrends. We are in a short-term or secondary downtrend. Having said that, if you were short into Tuesday, you got destroyed. Shorting is hard in bull markets. You have to be almost perfect. So what I would prefer to do is focus on building the shopping list of relative strength. We put out a report a few days ago, 2 days ago, I believe, highlighted some names. Throw those on your watch list. They don't have to go up every day, but they're bucking the trend. Why? It doesn't mean we're going to own all of them at the end of this, but we want to know why those stocks were not participating in the big moves to the downside. That, to me, signals institutional buying pressure, or at the very minimum, reluctance to sell. I want that information. Uber, we were just talking about, up 20% post-DR. We already have a trade on Uber above 64. We are currently trading above 64 again. New entry trigger if you're not in Uber, 72. Don't buy it here. I'm still holding a position in Uber. You don't want to own this trade unless we're back up and over those 72 level, and we're targeting the all-time high breakout into a $90 price target. This is not a trade going out tomorrow. This is a watch list trade. Build that shopping list. Above 72, this is going out. Interestingly enough, though, we did break above the 200-day moving average, failed to claim it, closed below the RSI, below the 50. Right? All of this stuff is going to seem redundant. We do not open trades below the 200. We do not open trades below the 50 RSI. It will keep you out of trouble. Palantir is another name. For whatever reason, once again, Uber and Palantir had incredible earnings reports. It's not our game, and that's totally fine. But Palantir held green all day, back around our original entry trigger at 27.5, up massively off of its earnings report. It's below the 50 RSI, so we are not entering this yet. Above 27.5, 28, somewhere around there. We are long Palantir again. I'm still holding a significant portion of Palantir. Had the question today, Palantir looks good. What should we be doing? Wait for the trigger. Wait. It will increase your odds of a successful trade. But Uber and Palantir, as of right now, my two favorites, when or if the market finds a floor. Both of these names, which were not on the report 2 days ago, incredible relative strength right now. Dash, incredible relative strength right now. Dash was one of our biggest wins. We opened this back in November of 2023, and we ended up closing in February and March of 2024. So we owned this thing for upwards to 5 months. Huge win for us. Gigantic win. Multiple hundreds of percent from contracts. We had guys holding shares up near the top. Back up and over its 50 RSI, back up and over its upward sloping 200-day moving average. We want to get long Dash again above 130. Let it fill its gap. Everyone's going to be trying to attack that gap. We don't need to. Excuse me. By the way, who had DoorDash at a $50 billion company? I always get thrown off when I see that. Mag 7 held its previous cycle highs. Microsoft, Amazon, Meta, Google, Tesla, Apple, Nvidia. Some of these are getting hit way harder than others. Those previous cycle highs, this is our little Mag 7 index, is important. We fall back within the range. We do not want to be opening new positions in Mag 7. We hold the range. There is life and hope that we do end up buying some more relatively soon. We're in some trades already. Let's look at the one that's holding up the best. Meta, in my mind, out of the Mag 7 stocks, is holding up the best. By the way, how ironic is it that last year during the summer corrective phase, Meta held up the best as well, and then went on to lead the Mag 7 stocks out of the correction? That trade that we talk about with IW Beyond Dustin, for those of you that aren't on the Discord side, nearly a $200,000 win in Meta. He bought in November and he held into Q1 of 2024. This was the exact setup that we were looking at, I challenge you to go look at it last year. It's going sideways when the market is going down. Say that again. Meta is going sideways while the market is going down. There's an incredible amount of relative strength in Meta. I don't know why. Is it Zuckerberg's new rebrand? He has long curly hair now. He looks super cool. I don't know. But Meta is not breaking down like everything else. So this is my top pick coming out of this correction as of right now. We want to own Meta on an entry trigger at 525. Full trade idea will be up when we get up there. We're not that far off though. We want to add into Meta. Some of us, including myself, still have call debit spreads for Meta. They do expire in Q4 of 2024. So this is something that we're going to be opening up more of if we're up and over 525. All right. Meta is the best from a relative strength standpoint. Mag 7 stock. It's better than Apple. Risk on, risk off indicator. Holding the previous cycle highs tentatively. So what I'm trying to accomplish with these indicators, this one in particular, is I'm grouping together classically inter and intra-market risk on ratios. And we get the trend of whether or not more risk on or more risk off indicators are doing better. As of right now, it shouldn't be a surprise that over the last few weeks we pulled back. Risk off has won. But those previous cycle highs are holding. That risk on type of mentality is still there. Until we fall below this range, which who knows, we could. I have no idea. We're not yet there. You have to assume that this is going to bounce and the market will eventually find a floor. Hopefully, we've just gone through like 60 slides where a bunch of the data looks really bearish and a bunch of the data looks pretty fine. Like this looks okay from just a pure technical standpoint. We've pulled back to previous cycle highs and we're holding. Most people would look at that, rational people, and go, that's a buy the support area. Now, this isn't a buy the support because this is obviously not an actual asset. These are ratios. But it goes to show you that this market is not risk-off bull market mode just like that. It's not. We have lots of choppy, nasty information to file through. So risk on, risk off telling us that everything is tentatively okay, finding support there. The average stock is back within the range. We are not necessarily breaking down. Value G is the ticker here, by the way, if you want to add that. We're looking at the performance of the average stock. The average stock has not participated very much over the last 2 years. We had a 2-year high breakout, and then we had the correction start immediately. Back within the range. This is not bullish, though. It's not inherently super bearish, but it's not bullish. It goes to show you that the broader market has been hit. Semiconductors leading to the downside. I added this just to show you the types of volatility swings in semis. Brutal moves if you were caught max long at the top. Check out those fib extensions, by the way. Same chart that we looked at in November of last year. Those fibs have not moved. If you need any convincing that those targets are generally agreed upon levels for most technicians, there's your semi chart. Finding resistance where it's supposed to. Check out NVIDIA really quick. We were talking about everybody wants to short NVIDIA. I get it. It's sexy. It's aggressive. It's fun. But there are so many institutional hands in NVIDIA right now that it's going to make it an incredibly hard short. Go back for that LSCC short instead, or some of the other semiconductors that are breaking down. NVIDIA right now down in between 28 to 30%. The previous oscillation low back in March also very volatile at 22%. This is a high beta stock. It's going to move like crazy. It does not mean that it's topped. At least not yet. 2.43 trillion. Holding above its 200-day moving average, the RSI is resetting potentially and oversold. Do we buy this dip? Not yet, but we probably will on the other side. Let this thing bounce. We will probably be net buyers of NVIDIA for the first time as a community this year. See a reasonable sell-off, or excuse me, not a reasonable sell-off, a huge sell-off will give us reasonable contract pricing. So when we go and actually look for the trade idea on NVIDIA, it's not going to be juiced 100, 200%. We're probably going to be looking at 50 to 75% discounts on those contracts, which is what I'm looking for. Communications holding up relatively well, right? Meta, once again, relative strength, guys. Added to the watch list. Total crypto market cap on the daily has been killed. The entire ecosystem of the crypto market is worth less than the company of NVIDIA. That's all I got to say. Yes, crypto's fun. There's great opportunities in the trading and investing space, particularly those of you that can stomach some volatility. But man, There's not a whole lot of money in this right now. There just really isn't. We would expect in a bull market that this would have broken above $3 trillion, which is what I expected. And instead, we resolved to the downside under the 200-day moving average, right? This is not great if you're an uber bull in crypto in general. Bitcoin. For those of you that opened the original position at 28,000 back in October of last year, I've said it before, I'll say it again. A close below the 50K mark means I'm taking profit. That's it. I will gladly rejoin. But I'm taking profit on a close below 50,000, which could be coming up. We broke below it just a few sessions ago. Failed to close, so the position's still on. This is just chop below the 200-day moving average. We do not want to be adding here from a technical standpoint. Whatever you do on the side, long-term investing, etc., completely up to you. Buying below the 200-day moving average tends to lead to bigger losses over time. And we're there. Look at Ethereum. Ethereum is the worst performing blue chip stock, if you will, this year. Terrible. Ethereum is down massively since its local high just a few weeks ago, 2 or 3 months ago, something like that. Down huge. You don't want to buy this stuff. Check out the underperformance of Ethereum against BTC. I mean, we talk about this all the time. Josh has pointed this out like 2 or 3 crypto reports in a row. You don't want to be long Ethereum as a opportunity to get away from Bitcoin. Bitcoin has outperformed Ethereum going back years. Over the last 2 weeks, we're sitting at 3-year lows in Ethereum's value against Bitcoin. So once again, if you had the option to either own BTC or own Ethereum, from a trading perspective, it's got to be Bitcoin. Ethereum is just underperforming everything. Solana holding up better than all of them. Just like Uber, Palantir, Dash, it's not up for me to decide why these things are holding up better. I don't personally know. What I will tell you, though, is Solana is holding up better than BTC and Ethereum. Solana, of all names, the only one trading at the 200-day moving average right now, by the way, and bouncing off support. The other names are no support to be found anywhere. So when it comes time to buy these things, remember, mental note, what were the names that held up the best during the market correction? Solana is that crypto name. Binance underperforming along with Ethereum and Bitcoin right now. So why would you want to go and own this stuff? Own the strength. Solana. It's Solana. I mean, that's it. You got to own Solana in this space when the market finds a floor. Gold holding up reasonably well, but still, you would have expected in a market that's correcting that gold was going to outperform, and it's not. Gold bugs are shaking their head, right? Peter Schiff is just about to have a cornea. Why isn't gold outperforming? But it's not. We have a gold trade on the books. It's doing fine. We've added into it. It's fine. But it's not giving us the huge push that most people would expect in a market that's riddled with volatility. Gold is pulling back along with everything. And by the way, we were just at all-time highs a few days ago. And now we're in the top part of that range that we've been building out for the last few months. Just brutal stuff there. EGO is a trade that we're currently in. Some of us are still in. I'm still in it. 7-year high just 2 weeks ago. And here we are pulling back in. These gold miners have not been an easy trade this year. We put out a trade idea on SA about a week and a half ago. Pulling back as well. You know, don't get bit by the idea that gold and silver and all of these names have to break out during market turmoil. It's not happening. So if you have the trade on, let it sit there until you get stopped out if it doesn't work. But there's no point in adding into this stuff right now. There's nothing. Look at silver, back within the range. You know how many people were screaming to buy silver? And I get it. When we were breaking up and out of the range, I was right there with it. I didn't take a position because I'm already long gold miners and everything else. They tend to move in tandem. But if you're back within the range, this 4-year horizontal channel, there's no reason to be long this stuff. Just wait. We have no idea how long it's going to continue to chop around. And then the dollar, kind of the last chart here I want to look at. You know, there's this inverse correlation between the dollar and stocks that we've been trading through for the last 2 years. And yet here we are right now, stocks down, bonds down, dollar down. What the hell is that about? Market regimes, that correlation is kind of breaking a little bit. Now, it's Unknown whether or not the correlation will break for good. I have a sneaky feeling it won't. I have a feeling that during inflationary periods, which we are in, not saying inflation is rising, but inflationary forces are greater than deflationary forces, right? For any of you econ nerds out there, you know what I'm talking about. Generally speaking, the dollar and stocks are going to be inversely correlated. So it's hard for me to assume that inflationary force is just going to be gone, within 2 years. It's just not. These types of environments generally last like 5 to 10 years, maybe sometimes even longer. But it is interesting to note that stocks are down with the dollar down, because generally speaking, the dollar was a hedge against stocks breaking down. Why? Because you could go long the dollar. You could go long UUP. That was a trade that we put on in 2022 or 2023. I don't remember which. I think it was 2023. It was last summer, actually. We put a trade on UUP. Little 100%er win. Stocks were breaking down. We didn't feel comfortable chasing puts. Same idea right now. And the dollar trade worked. As of right now, there is no respite in the dollar. The dollar is breaking down now. So this is a new type of market environment this summer. They're all kind of moving around the same direction. And all of that leads me to the last thing I want to say. Those of you that can remain patient the most are probably going to outperform the guys and girls that can't. If you can't sit on your hands during market volatility where there's no clean and clear trade to take or path to take, you will get chopped to shit this summer. Don't do it. You do not need to be in every trade. So let's talk about the big themes here. The indexes are pulling back after logical levels were hit, and there's some seasonal weakness that we've talked about for the last month. Plug and play any event you want. I don't care. Weak stocks are leading the way to the downside. We just looked through 5 or 6. There's going to be trade ideas put out tomorrow morning on some of those, but don't short everything under the sun. Any rally in the market, like we saw yesterday, for example, is going to cause all of the premium on those puts to go kaputs. And you don't want that. It's a very, very hard way to make money over the long term. Be selective with your shorts, but take the weakest stocks down. Do not try to be the hero shorting things like Apple. There's no point. You're here to make money, not an egotistical post on Twitter that you timed the top on NVIDIA. Higher beta sectors and industry groups are moving quicker, so think about this really quick. Most of the trade ideas that we're going to put out to the short side are going to be higher beta areas. We're not going to be taking a short on Coca-Cola that moves on average 1.5% per day. We're not doing that type of stuff. We're taking the more aggressive shorts, the ones that are going to take anywhere between 1 to 5 trading days, and we're out. We're not expecting new bear market lows. Base hits, guys. Weakness and volatility is expected to continue in the short term. We looked at all of the levels that we were looking at. All of the data continues to show CTAs have not yet bought. The COT reports telling us that commercials are still hedged. You have to assume that this weakness and volatility is going to be continued in the short term. Point of emphasis that will save your ass are indexes above the key levels. Write those down. They're going to come out in a report tomorrow morning as well, but write those key levels down on the indexes. SPY, QS, IWM. You get those above the key levels with the RSI above 50, it's game time to get back long. It doesn't have to be harder than that. We're not trying to time the bottom here. We're just trying to grab the path of least resistance to the upside. Build the shopping list of relative strength. Build it. We're already building it. Palantir, Dash, Uber, AMD to a certain extent, a bunch of other random stocks that we talked about 2 days ago. Build those. We don't need to own them right now. We have entry triggers to the upside that will be hit eventually, assuming the market finds a floor. We'll get in then. But remember, there's a reason why these stocks are not breaking down as the market continues to break down. We want to own those. And lastly, do not get complacent. The biggest wins come after corrections, guys. The biggest wins you will take come after the correction is over. There's a lot of people that want to head off in summer, and I don't blame you. Go take your vacation, etc. But don't detach so much that you are not available when the market bounces. You don't have to time it perfectly. We're swing traders. We don't need to grab the absolute low to the penny. But don't give up on trying to find that bounce and then participate on the right side. The biggest wins came last year out of the exact same market environment. All right? Reading kind of what you guys are going through. Spot on about the premium prices for longing options. Huge disadvantage. 100% agree with you. I'm glad that you understand that. Buddy just dropped $18 on a large Big Mac meal. That's insane. I make it a point to every country I go to like go to McDonald's and just kind of see what the menu's like. And you're right, it's super expensive. Don't want to speculate, but given it's election year, can a surprise cut be in the cards before September? Absolutely. So right now, I don't have the chart here. It's a good question. We're going to finish that, or we're going to finish this monthly charting session with kind of this conversation here is don't try to front run what the Fed's going to do. The market does a pretty good job at that already, right? We've talked about that all the time. A market front runs policy change because the market is privy to information that we don't have. I mean, it's just that simple. We talked about it earlier today. The Fed's, not technically allowed to be politically motivated, but it happens all of the time. I mean, it's in the data, right? Generally speaking, the Fed is more accommodative running into the election than not. Whether or not you want to say it's to help somebody, I don't care. The data does show that the Fed tends to be more accommodative. So, as of right now, there is a 100% chance that the Fed cuts being priced in September. There's a 100% chance. But now, since Monday's breakdown, there is... I don't have the number in front of me, but there is a chance that they could have a surprise cut now. Yes. I don't have the number in front of me, but you can look it up. Just remember, though, that rate cuts are generally short-term bullish. Long-term is a different conversation, but we'll attack that winter if it happens, right? The rate cycle, the cut cycle is going to, I think they said that it's going to extend out to 2026. So we have a runway, but still, yeah. Generally speaking, short-term bullish, long-term, it gets a little, it gets a little rocky. Okay, guys, I appreciate you for hanging out with me. It's a little bit shorter than usual, but hopefully you guys get the main theme here. Volatility is probably here to stay in the short term. Be patient. We will buy the right side of the dip, and we will take aggressive shorts to the downside. As long as the bread and butter setups are there, we're not going to chase anything. Name of the game is to hold on to your year-to-date profits. We have guys that are up hundreds of % this year. Let's not give that back just because we're bored in the middle of summer. Go putt. Go play golf or do something fun, all right? If you have any questions regarding anything we talked about, feel free to leave them below. I'm going to attach the slides down below so you have them as well. And look out for the trade ideas tomorrow morning around 6:30 a.m. I'll see you guys in the morning.